Hello everybody. Today I will be talking about ASC 606, a new standard that deals with revenue recognition for contracts with customers. The equivalent of this new GAAP standard in international world is IFRS 15. ASC 606 is principle-based guidance versus rule-based guidances that were available in previous GAAP standards. That means that ASC 606 can be applied to all contracts with customers regardless of industry-specific or transaction-specific fact patterns. The effective date for this new standard is after December 15, 2016 for public companies and after December 15 of 2017 for private companies. Before we jump into practical application of this new standard in Dynamics 365 for finance and operation, let's talk about terminology. Entity in a new standard is a legal entity or company in D365. Obligation in a new standard is a promise to transfer a good or service to a customer. And consideration in that new standard is a definition of the payment for the delivery of such goods and services. Revenue recognition in standard D365 for finance and operation is only available in project management and accounting module. It is not available in sales order, purchasing, or free text invoice subledgers. This review will concentrate on revenue recognition in fixed price projects of D365. This is a two-part series. In this video, I will be talking about revenue recognition in fixed price projects, and in a second video, I will be talking about revenue recognition as it comes to ASC 606 standards in time and material projects. ASC 606 principles are described in 5 steps. The first step is to identify customer contracts. You can see some definitions that were pulled from ASC 606 standard text that the contract can be either written, oral, or implied, and it should follow those 5 points that you see on the slide. So what is a customer contract in D365 for finance and operation? If we navigate to project management and accounting module and are going to go under projects, we see project contracts. Each project that we're going to create in D365, and I'm talking about fixed price project or time and material project, should be assigned to a contract. Among other things, contracts in D365 define billing rules, funding sources, funding limits, and funding rules. Now let's take a look at the second step of ASC 606. It is to identify all performance obligations. So what constitutes a performance obligation? Performance obligation is a distinct good or service that should be delivered to the customer. The definition of distinct is that the good or service should be capable of being distinct. That means the customer can benefit from that good or service either on its own or together with other resources that are readily available to the customer. And the second point is that it should be distinct within the context of the contract. The promise to transfer the good or service is separately identifiable from the other promises in the contract. So what is a performance obligation in D365 for finance and operation? Some ASV solutions have service items set up as some sort of performance obligations. We can go in the route where we can think about performance obligation as the cost template line, because we can create multiple cost template lines. The shortcoming of that is that the cost templates are not used in time and material projects, and therefore we're only limiting ourselves to fixed price projects with this approach. Based on my experience, a distinct obligation is better defined by a sub-project because we can assign transaction price and track completed percentage for each sub-project within a main project. Let's take a look at the project structure that I created in D365. I have a project 214, which is a Jackson contract. I'm going to open it, and because this is a header project which will not contain any postings, I marked it as such under project hierarchy section, define it as a header project. that this will prevent any transactions to be posted in this project. Underneath my main Jackson contract project, I have 3 sub-projects. First one is house construction, gazebo construction, and property monitoring. Each of my sub-projects has a separate estimate project. This is important because we would like to recognize revenue per sub-project, hence per performance obligation in D365. So we can see that project 214.01 house construction is assigned to an estimate project 214.01. Same goes for 214.02. It has a separate estimate project, and 214.03 separate estimate project. One of the gaps or limitations in D365 for finance and operation is that every project within my hierarchy, so all 4 projects, header project and all 3 sub-projects, should be assigned to the same project group. We can see that all 4 projects are assigned to project group 606 with CP, which is completed percentage. Now let's take a closer look at the setup of that project group. This project group is set up to be a fixed price project because we are dealing with fixed price projects here, but the revenue recognition accounting rule for this project group is completed percentage. So that means that within our project structure, we can only have sub-projects that follow completed percentage rule. I will be talking about completed percentage versus completed contract, or also known as completed obligation principles, in a step number 5 of this video. It's also worth noting that contract for each of my sub-projects can be different from the main one. For example, I may choose to assign a different project contract ID and hence different funding source for each of my different sub-projects. So let's summarize the step number 2. In my experience, the performance obligation in the system is better set up as a sub-project in D365. That means we can assign a transaction price to it by means of putting an on-account transaction, and we can determine the completed percentage for each performance obligation separately. So you heard me talking about a transaction price, and you're just wondering what that is. Step number 3 deals with exactly that. It determines a transaction price for each performance obligation. Before calculating a transaction price for each performance obligation, we need to determine a standalone price for it. So what is a standalone price? The standalone price is the price of that good or service as if it was sold separately and not a part of a contract. The standalone price can be defined by an observable price. For example, we can use a most likely amount or expected value. If observable price is not available, we can estimate the standalone price using either adjusted market assessment approach, expected cost plus margin approach, or residual approach, which is applied. The second gap in standard D365 project and accounting functionality when it comes to ASC 606 principles is there is no clear way of storing standalone price for each performance obligation. In my experience, the workaround for that will be defining forecast with sales price for each of my sub-projects. So the sum of all the forecast sales price will be an equivalent of a standalone selling price for my obligation, also known as, in D365 world, as the sub-project. So let's take a look for that. I selected one of my sub-project, which is house construction, and I'm going to navigate to Plan tab, and I'm going to select all forecasts. You can see that I have 3 forecast lines. The first one is for a service item, and it is called project item. And we can see that the cost of that is $80,000 and the selling price is $90,000. Then we have a second line, which is an hour category, which is a labor to build our house. And we can see that the selling price is $20 per hour. And in total, we have $20,000 because we have 1,000 hours of labor estimated for the project. And the third one is a contractor labor or contractor expense that is defined as $5,000 cost and $10,000 selling price. If we do the sum of my parts, which is 90,000, my labor, which is 20,000, and 10,000 for contractor expense, we have $120,000 that is an estimated standalone price for my obligation, which is the construction of the custom house. Again, this is a workaround. As I said, there is no clear way of storing a standalone selling price for each obligation in D365. I'm just working around this shortcoming by defining forecast lines and doing a sum of selling price for each of those items under my obligation to come up with a standalone selling price. So once we define a standalone price for each obligation, for each sub-project by means of defining it as the forecast lines, the next step is we need to calculate a transaction price for each obligation. Based on our experience, the best place to store transaction price for each obligation and therefore for each sub-project is on-account transaction. So you can see an amount here, and we will be talking about how we came up with this amount. And I have defined an on-account transaction, also known as transaction price, for each of my sub-projects, also known as performance obligation. You can see that I have a gazebo on-account transaction, as well as I have an on-account transaction for my property monitoring. The advantages of using an on-account transaction as your selling price is that we can recognize either full or partial amount of that on-account transaction based on the completed percentage and the passing over the control to our customer. The added bonus here is that we can see all on-account transactions under our main account. So let's take a look. I'm going to select my Jackson contract, which is my header project, and I'm going to click on-account transactions. So we can see that we see all 3 on-account transactions pulled from each sub-project, and if we summarize those amounts, we can see that the total of my contract is $120,000. So this is my fixed price to my customer, which is $120,000. Now, let's talk about how we came up with that split, because you can see that the sales price or transaction price for each of my obligation does not match to the sum of all of my standalone price. Because remember, the standalone price for the house was $120,000, but my transaction price for the house is $115,000, $200. This is where we need to talk about allocation of transaction price to our performance obligations. So here is a graph that defines 3 of my obligations: house construction, gazebo construction, and the property monitoring for 12 months period. We can see the total contract price that we negotiated with our customers, $120,000. So this is what we will be billing our customer. And we also talked about the standalone selling price, which is $120,000 for a house, $400 for gazebo, and 12 months of $50 per month, which comes to $600 for property monitoring. The sum of standalone selling prices is $125,000. So you can see that the customer is getting $5,000 discount because he bundled those obligations in under one contract, and he was able to negotiate a better price. Allocated transaction price is calculated as follows. It is a standalone selling price of each performance obligation, which is $120,000, divided over a sum of all standalone selling prices, which is $125,000, multiplied by the contract price of $120,000. So this is how we came up with an amount of $115,200 for our house construction sub-project that sits under on-account transaction. And you can see the same formula is applied to gazebo and the property monitoring. if we do the sum of all those allocated transaction prices, we should come to the same amount of $120,000 as our contract price. So let's take a look in D365. So we can see that the gazebo construction came up to $42.24. I'm going to open my gazebo construction sum project and I'm going to click on account transactions. And we can see $42.24 as a selling transaction price for that obligation, which is building of gazebo. An allocated transaction price for property monitoring for 12 months is $576. We're going to select our property monitoring sub-project and going to go on account transactions, and we see $576. The gap here is that calculation of that allocated transaction price for each obligation for each sub-project is done, unfortunately, outside of D365. So the system is not capable out of box to calculate a transaction price for each obligation, and we had to do these calculations outside of D365 and then input the results under on account transactions for each sub-project. This brings us to step 5, last step of ASC 606 standard, which deals with recognizing revenue when or as the entity satisfies a performance obligation. So you can see that there is a when scenario and there is as scenario, because revenue can be recognized over time, which equates to a completed percentage principle. That means every month, every week, with certain periodic function, we can recognize our revenue. But also, we can recognize the revenue at the point of time, which equates to a completed obligation or completed contract principle in D365. That means only when we pass control to the customer, we can recognize revenue. So let's talk about the qualifying criteria for each of those principles, because both can be applied, but we need to be challenged to determine should we recognize revenue over time or at a point in time. To recognize, an entity transfers control of a good or a service over time, therefore uses the completed percentage principle, and therefore satisfies a performance obligation and recognizes revenue over time if one of the following criteria is met. So the customer simultaneously receives and consumes the benefits provided by entity's performance as the entity performs. The good example of that will be a newspaper delivery. I can recognize revenue every month because every month my subscribers get magazines which they can consume benefits of reading. The second criteria here is the entity's performance creates or enhances an asset that customer control. A good example of that will be building a custom house for a customer on the customer lands, because customer controls the land, therefore they control an asset that is being built on that land. Therefore, in this scenario, the company would qualify to recognize revenue over time. And the third and last criteria is the entity's performance does not create an asset with an alternative use to the entity, and the entity has an enforceable right to payment for performance completed today. A good example of that will be a custom built software that is very specific to the customer, and the company, the software company that builds it, cannot resell that very specific custom software to anyone else because it was built specifically for one customer. And on top of that, the software company has an enforceable right to payment to charge a customer for that custom software. So either of those three principles have to be met to qualify to recognize revenue over time. Now, so once we qualify to recognize revenue, so how much revenue we recognize every month? So that's when the completed percentage comes into play. And this is a quote from the document. So entities shall recognize revenue over time by measuring the progress towards complete satisfaction of that performance obligation. That means we need to measure progress and recognize a corresponding percentage of the transaction price. So if we completed 30% of performance obligation based on either straight line, milestones, cost versus the actual cost versus the estimated cost, we may recognize 30% of that transaction price. When we cannot recognize revenue over time, we need to recognize revenue at the point in time. So we need to define when, at what time can we recognize that revenue. And that comes down to control. Whenever the customer gets the control of an asset or a good or a service, that time comes and we recognize the revenue. The things to consider about the control and when the customer gets the control are those 5 points. For example, the entity has a present right to payment for an asset. The customer has a legal title to an asset. The entity has transferred physical possession of an asset to a customer, and hence the control is with the customer now, and hence we can recognize the revenue at a point of time. You may remember that at the beginning I talked about different project group setups. And let me show you the group that we're using right now. This group is set up to recognize revenue using the completed percentage principle. That means we determine that the services or the obligations that are assigned to that project qualify to be recognized revenue using overtime principle. Another project group that we have set up here in D365 is a completed contract. That means we can recognize revenue at a point in time. We cannot recognize revenue before the control is transferred to our customer. We can only recognize it when the control is with the customer. As I said before, one of the gaps here is that all of my sub-projects should have the same project group. Hence, they should have the same revenue recognition rule, either completed contract or completed percentage. So that means all of my performance obligations should be either recognized over time or at a point in time. Okay, so now let's take a look at the revenue recognition routine in D365. Under my house construction sub-project, I have posted 3 transactions. Let's take a look at them. The first transaction was for the $10,000 cost for my house construction parts. The second transaction was for $6,000 of labor worth to build my house. And the third transaction was for $4,000 of contractor expense. So you can see the total cost of posted actual transaction is 10 plus 6 plus 4, which gives us $20,000 of the total cost. The total cost of that sub-project, the total cost of that obligation is found right here, and we can see it under our forecast. We can see the total cost for our parts is estimated to be $80,000. The total cost for our labor cost was $15,000, and total cost of my contractor expense was estimated to be at $5,000. So you can see the sum of all the total costs or estimated total cost was 80 plus 15 plus 5, which gives us $1,000. So the total estimated cost is $100,000 and the actual cost was $20,000. So you can see that we, based on the cost principle, which is how this project is set up, we completed 20% of that sub-project, of that performance obligation, because we consumed $20,000 out of 100 projected. So let's take a look how the revenue is recognized in this principle. I'm going to navigate to my estimate screen and I'm going to generate a new estimate. It's going to be for month ending in November. And the principle that I will use here, which again, there are a lot of blogs that explain how percentage completed is calculated, I will use the total forecast versus actual. So the system will compare the total forecasted cost to an actual forecast, to an actual cost to determine the percentage completed. And I will use the completion principle as automatic. In order for me to do that, I need to select the module that contains my forecast, and I do that. So we can see that the system calculated percentage completed of 20%, which makes sense to us because we use the cost as the basis and we know that we actually consumed 20 out of $100,000 worth of cost. The total contract value, which is that transaction price here, is $1,000. 151,200, which again is based on the principle that we define in this slide up here. So this is our total contract price for this performance obligation. And we need to recognize 20% of it. So the 20% of 115,200, if we do the math, will be $23,040. So we are quite happy with that result because we completed 20% of our house based on the cost, and we need to recognize 20% of the selling or transaction price of that house, which is $23,040. What I will do now, I can delete that estimate and I can calculate another estimate for the same period, but now instead of using any principle, I will use the manual calculation principle. So I'm still going to use the total forecast to actual, but I'm going to say, let me calculate that percentage completed, which is an alternative to using a system to calculate and suggest us percentage completed. We can take control over and say, we will tell you what percentage we feel is completed. So right now, the percentage complete field is blank, and we can say, for example, we feel that we already completed 25% of a house versus 20 calculated by the system. Once we change that percentage completed, we need to recalculate it. And this way, the system will calculate as $28,800 as the revenue to be recognized. All right, so I'm going to delete that estimate. And what I will do now before posting that estimate and showing you all the transactions is I will run a profit and loss statement on my main project, because remember, my main project will include all recognized revenue and all WIP amounts from all the sub projects. So I'm going to go under my project statements, and I'm going to make sure that I include my sub projects, and I'm going to just show the actual amounts. I'm going to click on calculate, and we can see that under WIP we have $6,000 worth of labor, $4,000 worth of contractor expense, and $10,000 worth of materials, parts to build the house, which gives us the total WIP cost of $20,000. If we navigate to the profit and loss, because we did not post an estimate yet, we can see that everything here is zero. We did not recognize any revenue yet. So once we see that, let's go ahead and generate that and post that estimate. I'm going to go back to my sub project. I'm going to click on estimate. I'm going to click on new. It's going to be end of November. I will use my total forecast to actual, and I'm going to make sure that it is set back to automatic. So the system will tell me what the percentage I completed. So system tells us that we completed 20% and we need to recognize $23,040. I'm going to agree with that. So we can see that we successfully posted and recognized $23,040 worth of revenue. Where can we see that? We're going to navigate to our main project and we're going to run our profit and loss statement again. I'm going to make sure that I include my sub projects, and I'm going to click on calculate. When I go to my profit and loss section, I see that I have accrued revenue of $23,040. That is based on the 20% of my transaction price of a house, which we saw before. To conclude this presentation, I would like to talk to you about the gaps. So the first gap is that we cannot combine overtime at a point in time obligations under one project, under one single main project. The second gap is that there is no clean way of storing standalone selling price for each of my performance obligations, hence sub-projects. Third gap is that we cannot calculate transaction price in the system. We cannot store calculated transaction price. We cannot calculate it. We can store it under on account transaction, but we cannot calculate it in the system. And the last 2 points are dealing with the visibility of future revenue to be recognized. We don't have a table for that, and there is some lack in reporting. So I would say the degree of fit of ASC 606 in standard D365 for finance and operation, project management and accounting module will be around 70%. Of course, there are multiple ISVs available, such as Binary Stream and TriBridge, that offer solutions on the upsource. And if you have any questions about this demonstration, you can always contact us at Nextone Consulting. Until the next time, hope you enjoyed it.